So, welcome again to Dollars and Making Sense for the week commencing the 25th of November. Welcome again, Henry Jennings from Marcus Today.
Pleasure to be here, Ray.
Wonderful. Good to see you again. And so let's kick off. Let's get straight into it. Again, another fascinating week. I don't want to focus too much this week on geopolitics. There's a lot of drama going on with impeachment talks and trade talks and the like. Let's talk specifically about what's going to impact our listeners and viewers' investing portfolios. So how did you see last week, Henry, with regards to the markets?
There was really only one event last week that made any sense, or certainly had the biggest impact on markets. That was Westpac. That was the allegations that Austrac are making about money laundering that Westpac has been engaged in on 23 million occasions.
It's amazing, isn't it? 23 million occurrences. Yep. I thought 11,000 or something was for NAB with their ATM was bad enough, but to know that we've now got a bank, one of the big fours, having broken the law that many times, I'm just amazed nobody's in jail.
Yes, I mean it's still allegations at the moment, so it hasn't been proved, but this is a civil case and the burden of proof is somewhat less for Austrac, and the fines could be quite large given that CBA was fined $700 million for their anti-money laundering problems that they had with those cash machines and various other issues they had. So the fine could be significant. Bear in mind as well that Westpac have just raised $2 billion in an institutional placement, and they're raising another $500 million at the moment through a share purchase plan. That money, or at least some of that money, is going to find its way back to the government or Austrac. I don't know quite where the money goes. It'd be interesting to know.
General revenue, maybe?
Consolidated revenue, I suspect, the Scott Morrison slush fund. But that would go back to the government in some sort of fine for Westpac.
So I guess that's one way that Joshy can balance the budget and keep it in surplus, right?
Yes, it certainly would be. But yeah, it could be a large fine. Westpac have come out, obviously, and apologised unreservedly for that. But I'm not sure that's enough for the market at the moment. There's obviously class action potential here as well, because they have known about this issue for 3 years.
Wow.
It's to do with a business they have which allows people to transfer small sums of money overseas, and it appears that they were kind of asleep at the wheel in terms of some people pushing money overseas to
23 million times, right?
Well, I think there's. I don't think there's 23 million times that's the allegation, but I don't think 23 million times are the concerning ones. I think there's about 3,000 or 4,000 really high risk transfers that have occurred. So it's been going on for a long time. It's been going on under the current CEO's watch, current chairman's watch. Both the board has and the chairman have supported the current CEO. But the market has been pretty savage in its reaction to this.
I think deservedly so, because, again, let's not mince words. Ultimately, it's going to be the shareholder and ultimately the customers of Westpac that end up paying that fine, don't they?
Well, it's the shareholders. If they've tipped in $2 billion, that's where the fine will be. So that money will go straight to the government. In some ways, and I was talking to someone last night about this, it's really hard for these financial companies. If you're using a bank to transfer small sums of money, a couple of $100 here, $1,000 there, to whoever, how does the bank know what the whoever is going to do with that money? It's very hard for the banks to say, well, we think that's a bad person and that money shouldn't be going there. How do you stop that? If I transfer, using a thing like TransferWise, which I've used a lot in the past, to sending money to my son or daughter in Europe, how do they know that they're not paying that money to somebody else, or what? It's pretty much kind of
I guess
pretty tricky to track.
I guess, but one of the things that one would hope, and being an operator of an investment fund myself, every investor that walks through my door, I've got to do a KYC, know your client. I've got to do an AML, the anti-money laundering, and a PEP.
Yep.
So I've got to know, are they a media risk or a potential of blackmail? And so from that perspective, Austrac makes me very honest in that regard. But again, even when I have contractors that I send money to in New Zealand, I've got to tell very specifically what that money's there, the purpose, etc. So yes, we can always fudge it. But my biggest question, I would go back to Westpac and say, have you had any audits done? Has anybody gone back and actually validated and verified any of these transactions over this period of time?
But it is very hard for them to audit the end use of the money.
Okay.
How do you do that?
I don't know, but again, we're not in, if I'm running a retail bank operation and I've got to be able to give a declaration back to the government to say, to the best of my ability, and I think maybe that may be the issue, to the best of their ability, has there been any concerted effort in any way? And again, you said it yourself, they knew about this for 3 years, and maybe one of the aspects of the class action that they're going to end up facing is, if they potentially knew about this, wouldn't that be something that a potential investor should know about before they put their money on the table and say, I'm going to invest in Westpac? Because that alone, that to me reeks of malfeasance, because if I'd known, hey, the bank I'm just about to buy shares in or invest in is going to be subject to a major government inquiry, well, I'd be sitting there going, I'm not so sure about investing in them at this point in time.
I agree with you. I mean, it is a problem for them, but it still goes back to the question of how much responsibility the carriage service or the bank has for what the money is ultimately used for. Clearly, there's anti-money laundering provisions, and they usually target sums of over $10,000. That's what they have to report.
They do, yes.
Now, if you're transferring $1,000 10 times, that should set off some
it does.
alarm bells. But still, then you have to say, well, it's not your client that you're talking about. Know your client. It's the end user of that money that is the problem. It's not necessarily your guy.
But the transferee as well. I guess one of the aspects that I guess I'm quizzical of as a general punter, I'd be asking them is, what spot checks do you have in place? Do you have algorithms that say, if I detect this consistency of, transaction, like you've said, not 10,000 but 10 by 1,000s. Do they have mechanisms in place? Do they have compliance officers?
Clearly not.
And I think that becomes the issue when profit becomes the primary driver. Aspects of compliance, in the same way when you look at the screw ups in the nuclear industry in Japan before Fukushima, compliance came down to cost.
Yeah.
And the reason they didn't comply was it cost too much. So if you can't comply, you cut corners. That's okay. We'll get away with it. And I think that's possibly an aspect. I mean, we don't know until they go and have a look under the covers. But, that's, I think, what people have some expectation. You don't check, every 23 million, but did they check at least a percentage of those to be able to satisfy themselves that they are adhering to their corporate and compliance regulations?
It's going to be a tricky one. They're obviously going to defend it. I would imagine, or at least come to some sort of settlement
with
Austrac. When CBA did the $700 million settlement with the Austrac guys, that was during the Hayne Royal Commission, so there was a lot more emotion there. Westpac have been very careful not to talk about child exploitation because some of this was involved in some of that. But it's, if they've got any sense, they will settle early and try and get this thing behind them and try and put in the place. But I think the market wants some scalps.
Well, I got to say, when, this week and next, being the last two sitting weeks of the year, I read in The Guardian and The Herald and The Age where, the government's looking to bring their integrity bill against unions where they can go and nail them for 3 errant bits of paperwork, yet the corporate leaders of a major bank with 23 million transactions seem to be being whipped with a toothbrush in comparison. I really wonder how they're going to sell that one.
Scot-free.
Yeah, very good. Or Josh-free even.
Scott and Josh free.
Scott and Josh free. So anyway, I think we'll be watching that with a great deal of interest, as will the other 3 banks in the same sector, because I guess by reputation and by decree they will get dragged down somewhat by Westpac as well, wouldn't they?
I would imagine that any financial institution involved in any carriage of money will now be looking at how they can police what the end user is doing with those funds. It's a really tricky area. I mean, I'm not a lawyer, but to me, it's a really tricky area. Businesses, fintechs like TransferWise, which has been massively successful on a global basis, transferring small sums of money to people who nobody knows who they are necessarily. That is a risk for them, I guess.
I'm sure, and they'll be reviewing their compliance. I use one down in Melbourne, PFX. again, very handy, good rates, and it's all great in that regard. So I think, yes, it will sound an alarm bell for people to start, I think, looking over their shoulder and being a little bit more worried, and I think diligent in their compliance in how they actually execute their requirements under AUSTRAC rules and regs. Okay, let's roll on. Again, for those that may or may not be aware, Henry writes a weekly blog at Beaks Down Under. I must admit, I get a bit of a chuckle. You know, we're both dads, but some of your dad jokes at the end of at your end of your week. Do you write those every day or just for the Friday?
No, I do. I do jokes every day.
Yeah, well, they're pretty sad, I got to say, but they do give me a little bit of a wry smile here or there. So again, I just for those of us old enough to remember, here's a picture of me with REM, and that's me in the corner. That one gave me a particular smile. We were looking at a few of those songs a while back. Anyway, and again, just out of passing interest for those viewers and listeners in the Sydney area, Henry and I will be doing the last show, the information night for the Australian Investors Association, hopefully with Rudi, Philippek
Van Dyke.
That's the one. And we'll be doing a bit of a panel discussion about the year that was and the year that's going to be. So those members and invited guests at the Australian Investors Association, that'll be the Tuesday night, the 10th of December. We'll give that a bit more of a plug in the next few weeks. But that's usually a great night, a lot of fun. We have a few guessing competitions, and also we lay down the groundwork for 2020. So that's that. I'm going to talk a little bit about interest rates a bit later on in the show. So again, out of interest. Now, rolling on, Henry, I sent you an email during the week, and again, I'll declare my conflict of interest because I am a fund manager in a fixed interest offering. I'd prefer to just simply ask the question and take a back step. This has hit the lines, and I've been watching these guys with a lot of interest. Mayfair 101 or IPO Wealth have been doing a lot of advertising. And last week they came out and did a pretty big event up at Dunk Island. What are your thoughts?
Nice place to go. It's a nice place to be hit by cyclones as well. It's there's a lot of razzmatazz around this, and a lot of the local community were very supportive. Dunk Island, of course, got ravaged a few years ago in a cyclone. In fact, I have a friend who was the assurance assessor on the job, who was actually on Dunk Island for quite some time.
So to be specific, 2006 was Cyclone Larry, and then again in 2011 with Cyclone Yazi.
Yep. So, investing on Dunk Island is not without risks, to say the least. It is a tourism project, I guess, so that also has some risks. There is a lot of razzmatazz and marketing hype around these sorts of funds. This Mayfair 101 seems to have really sort of caught onto that marketing feel. And when people are looking around for investments that are going to pay above average yields, they are going to be dragged into these sorts of things, and that's the problem, is that people do move up the risk curve. And there is no doubt that investing in a project in the Whitsundays, which is being affected by climate change, has risks, and whether you're getting paid enough for those risks remains to be seen. But certainly, would I invest in Dunk Island? Probably not.
Well, again, you made the relevant comment just then about the amount of risk that you're chasing for an appropriate yield. Have you looked at the yields that Mayfair 101 are promising their investors? And I mean, they've raised quite a substantial amount of money.
Yep.
And that's the reason I follow them, because I'm in the similar area,
yep,
and cap raising is always a challenge. Yep. When they're raising the kind of sums that they are raising at this risk profile, is what they're paying their investors appropriate, do you think, for the risk that they're potentially taking on?
I wouldn't have thought so. I'd imagine that if you had a 9 to 10% yield, that would probably be more appropriate for something of the risk profile of that kind of business. And I don't think they're paying anywhere near that amount in terms of...
No, I don't believe they are either.
So, you have to weigh up the risk reward. And that, of course, is one of the problems that we're seeing at the moment in the market, is that because interest rates are so low and people are not getting any return anywhere, they're moving up the risk curve. And they may see that risk curve as a different risk curve to what it actually is. And with enough glitz and razzmatazz and advertising dollars, you can change people's perception potentially of that risk curve, and make things sound a lot more blue chip, a lot more safe, and a lot more conservative than you would really imagine it to be. So I think you just got to be a little bit careful, and that's part of the problem in the market at the moment, is this risk. People are moving towards riskier businesses, riskier investments, riskier things like Mayfair 101.
So I guess my slight sense of humour in this regard says to, if there are climate skeptics out there that don't think climate change is real, well, this will be the perfect investment for you, because they've had 2 major cyclones in the last 15 years, and they were literally 1 in 100-year events. Yep. So by all accounts, statistically, if there's no climate change, there's no cyclone due through there for another 185 years. So they should be fine.
Yeah, I mean, for me, it's not just about cyclones either. I mean, tourism is an inherently risky investment. If you are developing a tourist resort, people's appetites change. And you're banking a lot of money on maybe the Chinese continuing to come, and we're seeing that slackening off. We're certainly seeing us being tarred with the US brush in terms of visitors now discovered elsewhere to go to see. Thailand, Vietnam for Chinese is growing big time. So you have to say, we're an expensive country. We're expensive and hard to get to. So you are taking a big bet on not just climate change, which is a big enough bet, but also on tourism generally, which is not the easiest space to invest in, and it only takes one disaster, like we saw with Dreamworld. Not that these guys are running a theme park, but one nasty thing to happen, and things can go very awry.
And I guess as a finishing thought on this subject, then I think it's always easy to talk up a market and an investment when you're using OPM, other people's money. And I have, again, a high level of concern when I see the kind of executive remuneration that is being dished out, and the kind of marketing people that are involved in here, aka Mr. Jones and Mr. Switzer and et al. These aren't cheap resources. And so, to all of you investors out there, when you see, and again, I use the Henry Glossy Index, the glossier the show, that means, okay, that's got to be paid for sooner or later. And I'll leave it, my thoughts on that. Moving on. Where are we at? Yes, I think it's a good time for a disclaimer. We were rather late last week, so Henry, over to you.
Okay, thanks for listening to Dollars and Making Sense, a weekly program about finance, money and investing. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, your financial situation or your needs. You should consider whether the advice is suitable for you and your personal circumstances, and if in doubt, you should contact an authorised financial planner.
Thanks, Henry. And again, we will disclaim early and often. And again, we are opinionated, very opinionated. So it's always up to you whether you take our advice and our opinions. Sorry, I retract that. It's not advice, it's opinion. We don't give advice at all. So, again, a really interesting article that caught my eye, and one that's always of interest to me, is diversification. We have a rather interesting stock market because of the way that it's made up. So finance and resource companies dominate. It represents roughly 60% of the share market by market cap. Okay, and RBA has a very interesting paper that, their research indicates this hasn't shifted much at all in the last century. And it turns out that because of the way that our stock market is configured, most people have roughly the same kind of exposure in their portfolios. The unfortunate thing, though, is that what that ends up doing is it weights many investors' share portfolios far too heavily in just 2 sectors. So, Henry, I wanted to talk a little bit about diversification today and some ideas. We've talked about these already in the past. Maybe illuminate us on some things around, exchange-traded funds or bonds as well.
Yeah, I guess, one of the problems with the Australian market is the tax system that we've got, which does enable the financial companies to get bigger and become more attractive. And as you say, it becomes such a big part of people's investment portfolios. And you have some people that think they're diversified by having each of the 4 banks. That is,
and both miners.
and both miners. That is, at least with BHP and Rio, you do have some genuine diversification if you want to invest in resources, because they have different different commodities that they are exposed to. So you do have some diversification there. If you went for something like Fortescue as your mining exposure, you have got pure iron ore exposure. Whereas at least with BHP and Rio, you've got some copper, you've got some diamond, you've got oil, you've got coal, and you've got even nickel, etc. So there is some diversification there. But a lot of people now are looking at how they diversify away from the four banks, especially given the fallout from the Royal Commission and what's happening with Westpac at the moment. So exchange traded funds are a really good, cheap, off-the-shelf way of diversifying a portfolio, and this has become a massive part of investing.
And it's a pretty simple way to invest, isn't it?
It is up to a point. Exchange traded funds are basically instruments that reflect an underlying asset value, and they could be, an exchange traded fund could mirror what gold does, or it could mirror what the oil price does, or it could mirror what the Nasdaq does, or it could mirror what the S&P does. So all of these kind of funds mirror and perform exactly the same because they invest in the underlying assets.
And there are thousands of these permutations out there, aren't there?
There are about 228, 230 ETFs in Australia. In the US, it is...
It's about 2,500, 3,000.
You dream it, it's there.
Yeah, they can invent them pretty darn quickly.
Now the problem with ETFs, and this hasn't yet come to light because we haven't been through a GFC style event, and one of the problems that people perceive is the liquidity events. I'm not sure that is a big problem for the vanilla ETFs, and these are ones that replicate an index or a commodity. I think the problem comes with an ETF is when you have what they call geared ETFs. So they're actually adding some secret sauce to beef up.
Talked about those in previous show.
Yeah, to beef up that performance that they have in the ETF. So you can diversify into a myriad of things in Australia. Some have got this vanilla exposure, and you can just say, I want to invest in Asian stocks or European stocks, and you can get an ETF on that basis. And the great thing is that they are pretty cheap to in terms of fees.
The actual fees are very, very low.
Very low fees. There's no performance fee, unlike with a managed fund or with Magellan or these sorts of people who charge you a performance fee if things go really well for them. So that is a really good part of it. They're also quite liquid because they are trading in the underlying assets on the back of it, and if the underlying assets are liquid, therefore the ETF's liquid. But I think you just have to be a little bit careful about the leveraged ones that add the secret sauce, because we don't know how they will react under a stress situation. They could be good, they could just react normally, or they could have issues. But certainly, for investors looking to diversify, there are a myriad now of resources talking about ETFs. There's a company called StockSpot, which
that's Chris Bricky's mob,
which all they do is ETFs, and Equity Mates as well, which is a group that's really talking to, I like this term, this is one that I came across this week, Henrys. And Henrys are high earners, not rich yet. And the Henrys, Henrys of this world are those that have just sort of finished uni and are now embarking on their careers in being lawyers or accountants or doctors, and they're starting to accumulate some wealth, and things like Equity Mates and StockSpot to a certain extent fulfill a need for these guys because they want to invest, but they don't really know how to invest.
ETFs is a great way to do that.
And ETFs is a good way to start. Even there's even a platform called Raise, which used to be called Acorn, which is just a way for you to put small amounts of money into an account, and that money is invested in an ETF.
Yeah, in fact, I chat quite frequently with Stapleton Asset Management. They have a fund, I think it's iTrust, which they market to school kids and grandparents and the like, and you can invest in that for as little as $5 or $10.
Yep.
And their primary fund is Magellan, in fact.
Yep.
So they give people an opportunity to be able to invest that way. Their fees are very, very low,
yep.
and it's popular as anything. And again, it's a great way for people to dip their toe in the water. Henry's, I love it though. I love it. So again, this particular report coming out of the RBA was excellent because it's now, because SMSF trustees are looking for other places to put their money, they're now starting to look at ETFs, exchange-traded bonds as well, and also looking at managed funds, particularly internationally. Because again, we make up about 1.5% of the world market,
a gnat's bite of the world market.
A gnat's bite, yeah, that's a good way. That's a good measure. and that's very accurate.
It's very little on the world stage. But for local investors, it's sometimes hard to get your head around investing in things overseas. We all know the Amazons, the Facebooks, the Googles, and people, overseas investors, not just from Australia but around the world, I would imagine play the same game that we do, is you buy the names that you know, hence the fact that the FAANG stocks, the Facebooks, the Amazons, the Netflix, etc., have done so well, because you've got a globe outside the US that's looking at those companies going, well, I understand those companies, I'll just buy those ones as my international exposure.
Yeah.
And maybe that's a good
and there's
thing.
nothing too wrong with that. Again, I remember when Facebook was listing, and everybody was balking at the IPO price of around 100 to 120 at the time. 120 US bucks, I think, was what they ended up floating for on a market val.
I think they floated at $26.
I'll have to go back and look.
And
at
I
that.
even went on Channel 10's The Project in the on the breakfast show and talked about Facebook, because when they came on, they were such a miserable performance. I think they were sub $20.
They're not anymore, are they?
Nope.
And again, I think that's a good segue. Again, we don't dream up these topics on the fly, ladies and gents. We actually do plan a little bit about this. And one of the things that I wanted to talk to Henry today, and Facebook is actually the subject of this topic in our next phase of today's Dollars and Making Sense, is about the ethics around investing in certain companies. And again, there's another very, very good article in this week's press around Facebook's results. Now, by any measure, when you look at the kind of revenues that this company delivers and the kind of money that they generate, it's astounding. It is just astounding. According to this article, and when we look at the Facebook family of apps, we're talking about Facebook, Instagram, WhatsApp, and Messenger. So the monthly users have now grown from 2.45 billion, have grown to 2.45 billion from 2.27 over the same period. So roughly 21% of the entire planet uses a Facebook product at least once a day. And by any measure, if you were to start a business out 20 years ago and think, 1 in 5 people on the planet are going to end up using my product every single day, you wouldn't dream it, could you?
No, considering also that Facebook doesn't exist in China.
Which is astounding when you think that's...
So you're taking 1.5 billion straight out.
Straight out of the equation. So that makes that number...
It's nearly half.
Even more compelling.
It's nearly half.
It really is quite compelling. Now, the reason I wanted to talk about Facebook, again, in the last few weeks, if you follow any of the geopolitics in the United States and around the freedom of speech discussions and the impeachment trials, etc., and the 26 Russian hacking... Mark Zuckerberg, to me, I think was quite astounding in saying, coming forward, that yes, he believes in freedom of speech, but to the degree that he will continue to accept advertising on his platform, even though he blatantly knows it's not true. And so, Henry, my question to you is there a line in the sand that people should draw when they look at even an incredibly top-performing company like Facebook, and they simply say, you know what, I can't stand the ethics of this particular mob, along the same ways as British American Tobacco, or a nuclear company, or a company that logs, for example. Is there a line in the sand that people end up getting to, or is it? Do you see from your perspective that people go, no, what the heck, a buck's a buck, I'm going to take it?
Well, there is that school of thought. I've got to say, there is the school of thought that says a buck is a buck. However, the new investment world, and this doesn't apply to retail investors, obviously, because they have their own ethics and they put that over whatever they buy and sell. But certainly in fund management land, there is a big focus now on what they call ESG, which is ethical, social, and governance. So there is a big focus now on companies that are doing the right thing by the planet, by each other, and certainly from a governance point of view. ESG investing it is a massive thing, and a lot of fund managers have that ESG built into their mandate. So Facebook is an interesting one. I guess it is being accused, or it's being trying to put at the moment in the basket that they're actually a publisher as opposed to just a platform, and as a publisher in Australia, we've got some serious libel laws here and defamation laws. And as a publisher, the rules are very different for Facebook as a publisher as they would be for a platform. So that has some repercussions. But ESG is a big thing. And certainly in terms of performance-wise, it's not debilitating to have an ESG bias and to put that into place. There's a fund, Australian Ethical Funds, AEF, which has, does what it says on the tin. It is an ethical fund, and it buys things that don't involve.
I know the MD there actually.
Fossil fuels, etc. And it's done very well. And
yeah.
Hunter Hall used to be the big player in the ethical space, but that kind of all changed. But certainly AEF has been a big winner from that.
Well, I think there's positives, and I guess the only negative that I think really comes, ladies and gents, that if you do invest in these companies that put themselves out and cross that line, sooner or later, they may end up becoming a risk because of regulation. And I mean, Elizabeth Warren is a contender right now. She's made it very, very clear that she'll come after some of these. Whether she succeeds or not's another thing.
Yeah, I mean, for Facebook, regulation is the biggest issue, but you become so big and so powerful, it's really hard to regulate after the fact. The governments around the world are playing catch up.
Not wrong. Okay, now again, I do my weekly review from AICD as well. An interesting point there that they note that although we have high household debt and mortgages, the really key thing about Australian mortgage payers is, guess what, folks? We pay our bills. We have one of the lowest default rates in the world when it comes to mortgages. So I think from that perspective, whilst there is concern around the current debt levels, Henry, do you think that's something that is a burden on things at the moment, or given the fact that the default rates are still pretty low, that we should just keep a watchful eye, but not twiddle too much? Sorry, not twinkle.
I suspect. Well, apart from the fact that we have ingrained housing into our DNA, that you should buy a house. The other thing, of course, is that as interest rates come down, most people are too lazy or just can't be bothered to actually change the repayment level.
We've talked about this on a number of occasions, haven't we?
And rightly so. So they just get used to paying whatever it is a month. And if it's a little bit less, they just keep paying the same amount every month because they know that will get the debt down, and that gets them in front of their payments. So every month or week or fortnight that goes by where you pay that little bit more, that affects those numbers. So bad debts for the banks have been remarkably low. As I say, it is ingrained into our DNA on housing. We don't have the same mentality that US had in the GFC. You just flip the keys.
Well, that's recourse borrowing as well, though.
Yep.
We have full recourse borrowing, whereas they don't.
Yep.
And again, maybe for another time, listeners, it's well worth exploring that psyche of recourse borrowing against non-recourse and why that was a big factor in the GFC about 11 years ago. Okay, to finish off this week, Henry's picks. I must say I'm really pleased, and I'll be posting this week on our blog on otgcapital.com.au. I am putting on Yahoo Finance, and again, if you've never used Yahoo Finance, totally free site. You can do all your stock tracking. I think Motley Fool does something similar, Google Finance, so a lot of the popular information sites. So what I've done, and I'll just quickly show the camera there, I've simply put that into a watch list, and since week by week with Henry's tips, all I've done is simply put in 100 shares at the closing price of the day that you recommend. And at this point in time, I think we were talking about this on Thursday, weren't we, Henry, when we had a coffee? And at that stage, we're about 4% down on that particular day because it had a pretty off day. But, it rebounded again on Friday. So Henry's portfolio at this point in time, for the 6 or 7 weeks that we've been operating, is up a total of 4.34%. Now, if you were to annualize that over a 12-month period, it will inflate and look like something like 35 or 48. I haven't done the sums, but because these are staggered, that's not exactly all on the same day. But this particular portfolio contains Zip, Xero, Macquarie Group, Chimic, WiseTech, Premium, and Magellan. So when we look at that this week, Henry, are there any additions or deletions at this point you want to make to the dollars and making sense portfolio?
No, I don't think there's anything. I mean, a lot of these are high risk. They're kind of speculative. The Zips, the Zeros, The WiseTechs and the PPS are pretty speculative, so you've got to bear that in mind with these things. They do tend to bounce around, but certainly nothing there. Zip's been doing pretty well. Xerox been doing pretty well. WiseTech's been under a bit of pressure again because of the short selling attack, but generally the market feels okay. I think I wouldn't change too much of that. One stock that I have been looking at, which viewers might be interested in, is a stock called PointsBet. PBH is the stock code there. They've just done a rights issue at $3.50, $3.60 to raise some money, quite a lot of money actually.
Are they advertising on the telly?
Could be. They do sports betting in the US.
That's it. That's what I saw.
US.
Why would they be advertising here locally?
I don't know, but their big avenue of growth is the sports betting market in the US.
Okay, so shall we add them to the list or not?
I wouldn't. No, you know why? Because we've just talked about ESG, ethical, social, and governance, and PointsBet, although is a good stock and a good bet for next year, it probably doesn't fit in with the ESG.
Okay. All right, Henry, that's it for the week. And again, thank you so kindly for coming along, having a chat to us here at Dollars and Making Sense. Ladies and gents, we always appreciate your comments and the like. Now, there is a lone YouTube down thumber. I'd be more than happy to hear from you. If you're not liking what we're doing, please let us know. We're always looking on the improve. We're buying bits of extra kit and hopefully improving the lighting and playing around with a bit of software and that. So we're still very, very much a work in progress. So check out our socials. Don't forget, we're on Radio Northern Beaches every Tuesday at 8 a.m. We're on a Wooshka podcast and we're on YouTube 24/7. So please have a look. I try my best to have an annotation there. So if there's any particular area you want to just quickly jump to, go right ahead. And again, Henry, until next week, thanks so kindly for your time.
Pleasure.
Viewers and listeners, thanks for watching.